Would I rather have the majority of the British people thinking that rates are likely to go up in the next year, which is the case today? Yes, I would, because that is reasonably prudent behavior given the progress this economy is making.
The fact that rates will go up in 2016, I think that's the right thing to think. That's what Mark Carney is trying to say. Markets had priced in the first rate increase in 2017 when the sort of forecast was closed in the inflation report. The interesting thing and the kind of key thing to look at is the inflation forecast in a few years' time. You can see that there's still quite a relatively significant overshoot of inflation.
I heard him speaking to the man on the street. He was saying, make sure you've saved up enough money to pay the fee on your next 2-year fixed-rate mortgage. And so that is a prudent message.
We see them growing in the high 2s over the course of our forecast horizon. That is material for demand for the UK, and it's one of the reasons why we see our economy continuing to progress. I'm quite confident that they will make the right decision at the right time.
Economist surveys remained of the view that they probably would go. Not everybody, of course, but they remained of the view that they would go over the last month or two when the money market wavered. Now, the money market, of course, was looking at the spate of weaker data, particularly, of course, that payrolls data a month ago, which was very disappointingly weak. But maybe economists were more likely to listen to what the bankers or the central bankers were actually saying, because Yellen has set out the stall, suggesting that a rate hike in December is likely. But again, we might have a very dovish set of commentary, perhaps a little bit like Carney. He's suggesting they will hike rates next year, but he did so in a very dovish way.
Anytime you've had a very sharp increase in credit growth, as you have in China and more broadly in non-Japan Asia, one can expect at some point there'll be an uptick in non-performing loans. We haven't yet seen that. The increase in private credit, the increase in aggregate credit actually in China, it has doubled to more than 2 times GDP over the course of the last 5 years.
We're in a kind of new dynamic, aren't we, in terms of what's happened, the length of period we've had with low interest rates, low inflation. And I think the China story surprised people a little bit. It's been clear they've been moving to consumption from export. That is a healthy thing. We need that. I think there was a sort of tip-on effect into emerging markets. We then saw a collapse in oil price and commodity prices. This set back people's confidence. Not so much that we would have no growth, but we would have less growth. And that has, as you've seen in the last few weeks and couple of months, concerned the markets. We've had a number of figures, employment figures that haven't been quite as good. And I think probably on balance, the theory here is I think we must keep a close eye on that and make sure we don't in any way inhibit the recovery we've got here in the UK.